Hello everyone. In today's video, we'll be discussing about non-current assets. Before we start to understand what non-current assets are and how does a company records them in their financial statements, I would like to introduce you to the concept of balance sheet, or what we call it as the statement of financial position. Now, when you look up at the financial position of a company, you need to understand that it talks about two things. The first thing it talks about is that where exactly an organization is getting its funding from, which could either be from the investors or the shareholders' own money, which we consider it to be as an equity, or they can borrow the funds from external and third parties, which we consider it to be as your liabilities. Now, together, all this funding is invested in resources, or in financial language, we call them as assets. So basically, assets are all the resources of the organization, and that's what a balance sheet does. That it shows you that where exactly the company has got its funding from, which is either from the investors' own money or from external parties, and where that money has been invested in what resources actually. And those resources we term as to be as the assets of the organization. Now, moving further, when we talk about asset, we classify them into either non-current assets or current assets. Now, it all depends on the intention of the organization when they buy a resource or an asset. So, for example, if the organization buys a property, it's a resource for the organization. It's a resource for the organization. And now it all depends on the intention of that organization, that for what purposes they have bought the property for. So, for example, if the intention of the organization is to use that property in the business, we consider it to be as its non-current asset. But on the other hand, if the intention of the organization is to sell that property within its normal trading activities. I mean, the purpose of the organization or the objective of the organization is to buy and sell properties, for instance, then it will become a current asset. Now, what are non-current assets? As I explained you, that these are the resources or these are the assets of the organization which are bought for the with the intention of using it in the business. And what's the purpose of using it? So that the company can derive economic benefits, or we can say income or revenues from its use, rather than to sell it in the normal course of the business, in the normal trading activities of the business. Now, furthermore, these non-current assets can be classified between tangible or intangible assets. Okay, so tangible, the example which I gave you of property earlier was an example of a tangible non-current asset, because you can physically touch it. It has a substance, and hence we consider it to be as your tangible non-current asset. But on the other hand, if a company has a license or a copyright or a patent, for example, or its goodwill, those are all intangible assets, because they don't have a physical substance and you cannot physically touch them. And other distinguishing factor of a non-current asset is that they are less liquid. They are not easily convertible into cash. Even though if you convert your property into cash, for instance, it will lose its value. And what you have actually paid for it might not be the amount what you are actually receiving for it when you're selling them off. So those are your non-current assets. Now, whenever a company does an expenditure, it can be classified into two categories. Either we have a capital expenditure or we have a revenue expenditure. So, any expenditure which is done with respect to acquiring non-current asset is called as your asset expenditure or your capital expenditure. So, that expense can be done in acquiring them or in order to increase their economic benefits. So, for example, if initially I had spent, I have done an expenditure on buying a shop, for example. Later on, I have done some enhancement on that shop. That as I've extended the area of the shop, that is also considered to be as capital expenditure, because with more extended shop, I might be able to earn more revenues. So hence that is also called as a capital expenditure. Now, it's very important that you differentiate between capital expenditure and revenue expenditure, because capital expenditure has to be recorded in the balance sheet, in the statement of financial position. Hence, if you not classified correctly, the recording of it in the financial statements will also be incorrect, leading to your misstated assets and profit figure. So for capital expenditure, it will be recorded in the balance sheet, and we therefore say that it has to be capitalized. But whereas on the other hand, these revenue expenditures are done on your current asset. For example, if you're buying inventory for reselling purposes, or you're doing any expenses so that you can run your business, like your rent, electricity, utilities, telephone, and all that stuff. Or if you're doing repairs, for example, so that the earning capacity of an asset can be maintained, that is also considered to be as your revenue expenditure. And all of these expenditures are to be recorded in the income statement and not in the balance sheet. They are recorded in the income statement as an expense, in that is called as your statement of financial performance. So hence it's very important that you distinguish between a capital expenditure and a revenue expenditure. Capital expenditure will help you to earn economic benefits, that's increase in revenues, and hence they have to be recorded in the balance sheet. Whereas revenue expenditures don't help you to earn economic benefits. They are there to maintain the earning capacity of a non-current asset, and they are also expenditures what you do on current assets and in relation to run the business in the normal course, and hence we have to expense them off in the income statement. Now, once we have understood that, yes, this is our non-current asset, let's suppose the property, which earlier I gave you an example. Now the question arises, at what value are you going to record it in the balance sheet? So that's what we call it as the measurement of non-current asset, because when you pass a debit and a credit entry, you have to do with a certain amount. And that amount is the measurement of non-current asset, which as per I-16, it has to be done on its cost. Now, how to define cost is all the amount which has been incurred to bring that non-current asset, let's say machinery, to its condition, to its location as the management wanted. So all the cost which you have to incur in order to purchase that machine and then to bring it to the location of the factory and to install it, and so that it comes into a working condition, all of these costs are together clubbed as a cost, and it's at that value at which you will record it in the financial statements. Now, I-16 property, plant and equipment have given you a list of what to be included in cost and what to be excluded from the definition of cost. And those which are excluded from the definition of cost, you have to consider them as expenses and you have to record them in the income statement or the statement of financial performance. So here's the list of what includes and what excludes. Now, if you look up at the including part, you have the purchase price of the asset, you have its delivery cost, your legal fees, your installation cost, and any cost which you have to do in terms of trials and tests before you are sure that the asset is in its working condition. So all of these costs, you have to capitalize them. You have to record it as part of the cost of your non-current asset. But on the other hand, costs like repairs, renewals, repainting, administration, general expenses, indirect cost of the company, training to the employees to run the machine, for example, to operate the machine, or any wastage or abnormal losses would all be considered to be as an expense in the income statement, and you don't have to capitalize them in the cost of the asset. So once you have decided that this is our non-current asset and this is the cost of the asset, you have to pass an entry which is debit non-current asset. An asset will increase on the debit side, hence I'm saying debit non-current asset. and the credit can depend on whether you are doing a cash transaction or you're doing a credit transaction. If you have paid cash or through your bank, for instance, so in that case, your asset of cash and bank is decreasing, and we say that the credit entry will be of cash or bank. But on the other hand, in case if you have taken a loan to fund the asset, for instance, so we'll say credit, bank loan, or payable, because as you know that a liability will increase on the credit side. Now, as you can see in this question, it says that Billy started a business providing limousine taxi services on 1st of January 2015. And in the year to 31st December 2015, he has incurred the following costs. So these are all the costs which have been given to you, which have been incurred by Billy in his limousine taxi services. So now we need to understand that what amount shall be capitalized as land and buildings and motor and vehicles. So you have these two categories of non-current assets over here, and we need to understand, or we need to figure out that what cost will have to be capitalized as part of land and building, and what cost will have to be expensed out in the income statement. So if you look up at the first cost, which is the office premises, this is the purchase price of the premises, and hence it has to be capitalized. On the other hand, as I explained to you that legal fees associated with the purchase of office, this would also be capitalized, because unless you're not paying the legal fees, you won't be able to utilize the benefits of the office premises. So this amount of 10,000 will also be capitalized. But if you look up at this amount, cost of materials and labor to paint office in Billy's favorite color, purple. So this doesn't add up to any economic benefits for the organization for this limousine taxi services, and hence this would be considered to be as an expense in the income statement. So for the land and building, the total turns out to be 250 plus 10, that makes it up to 260,000. So 260,000. The entry in this case, you can consider that it will be debit, your non-current asset, which is land and building, with the amount of 260,000, and credit will be, let's suppose if I have paid through my bank account, Billy has paid it through its bank account. So credit will be bank account with the amount of 260,000. But now moving further for the motor vehicles, you can see that he also purchased Mercedes E-Series estate cars for 116,000, which will be capitalized. Number plates for the cars, without the number plate, you are not being able to drive the car and earn any economic benefits. So this amount will also be capitalized. Delivery charges, yes, that is also going to be a part of the cost of the asset. However, the road license fee is an annual expense, and you have to pay it every year, and hence this will not be capitalized, and it will be considered to be as an expense in the income statement. Likewise, the driver's wages for the first year of operation, this is also an annual expense done to run the company, and this will also not be capitalized into the cost of the motor vehicle, and this will also be expensed out in the income statement. Blank taxi receipts printed with company's name and address. This is also consider, it won't be actually helping you to earn any additional economic benefits, and hence this will also be considered to be as an expense in the income statement. So what we have over here is 116,000, 210, and 180. So this gives me a total of 116,390. So your motor vehicles will be capitalized at an amount of 116,390. So for that also the entry will be debit motor vehicles with the amount of 116,390, and credit, again assuming that Billy has spent cash bank money from its bank account. So bank account credit with the amount of 116,390. But for the other amounts, what we have over here, 300, 480, that's 780, plus 450 and 60,000. All these amounts will be considered to be as an expense in the income statement. So when you're making the income statement, you have to treat all of them as your expenses. So uh, from the land and building side, you have an expense of 300. And from the motor vehicle side, you have a total over here of 60,000, and 480. That will make up to 930. And yeah, so 60,000 930. That will be your motor vehicle expenses. So it's very important that you classify the costs correctly, because if you will not classify them correctly, your assets and your profit figure will be misstated. So it has to be very carefully categorized between capital expenditures and revenue expenditures. Now, moving further, we might have a subsequent expenditure on the same asset which you have initially recognized. In this case, you need to understand that whether the expenditure is helping to increase the economic benefits or the earning capacity of the asset. So, in that case, you have to capitalize it into the cost of the asset. It means that you have to increase the cost of the asset. For example, if you had a shop building and later on you have extended the size of the shop building, so having a larger shop building will help the company to earn more economic benefits. It will increase the earning capacity of that shop building, and hence the cost incurred in extension of the shop building will have to be capitalized. But on the other hand, if you are just simply doing repairs to that shop building so that it's in its normal and original condition, in that case, that subsequent expenditure done on the shop building will not be capitalized, and it you just have to treat it as an expense in the income statement. So simple logic, any expenditure subsequently done on the asset, you need to understand, you need to determine that is it increasing the economic life or the benefits of the asset, or it's purely maintaining it to its current levels. If it is increasing the economic benefits, you need to capitalize, or you need to put that amount into the balance sheet, into that cost of the asset. But on the other hand, in case if it is only helping you to maintain the economic benefits, like if you're doing repainting or repairs, uh, in that case, you don't have to add it into the cost of the asset. Rather, you will consider it to be as an expense in the income statement. Now we will talk about depreciation. Now, before I jump into the concept of depreciation, I want you to understand that because the capital expenditure, what you was doing, was being recorded in the balance sheet. Okay. But from that asset, you are deriving economic benefits, you are deriving income. Now, it will be very unfair that you're only showing the income of that asset, but correspondingly, you're not showing any relevant expense of that asset. Hence, what we do is that we charge depreciation. It's actually not a cash expense, like you don't have to pay for it, the company doesn't pay for it, but rather it reflects the cost, the part of the cost of the asset which has been used in the current year to generate the economic benefits, so that we have a fair representation of the profit or the loss what the company or this asset is making. Okay, so that's why we do charge a depreciation. So what is depreciation? It is a systematic allocation of the depreciable amount of an asset over its useful life. So all the useful lives of the asset in which it has helped the company to generate economic benefits, you have to charge depreciation in all of that year. because initially when you record the asset, you didn't record it in the income statement. You record it as your resource in the balance sheet. Hence, over the period of time, you have to reduce that cost and reflect it in the income statement. What we do it through a term or an expense called as depreciation. Now, when it says depreciable amount, it actually means the cost of the asset less any estimated residual value. Now, what is residual value? That is the amount what you expect to get it at the end of the asset useful life. So you take the cost of the asset and you subtract the estimated residual value, or we can even term it to be as scrap value, and that turns out to be your depreciable amount which you have to charge over the asset useful life, to reflect the cost of that asset, which is helping you to generate economic benefits, that which you have already recorded it in your income statement as revenue. Now, it will be charged from the date the asset is available for use and not when it is brought into use. Okay. So once you have the asset in the organization, you have to start charging the depreciation, irrespective of whenever you're bringing it into actual use. Okay. So even though if the asset is idle uh, uh, for some period, still the depreciation as per the accounting rules will be charged from the date it is available for use and not actually when the company is using it. And we have a couple of depreciation methods to charge the depreciation. The method that will be chosen will be the way in which the asset is giving the company, the organization, economic benefits. So the way in which the organization is getting benefits from the asset, depreciation will also be charged on that way. We have a couple of questions which once we do it together, it will help you to understand the concept in more detail. So let me give you a quick brief on the methods of depreciation. The first method of depreciation, what you have is a straight line in which every year you charge the same consistent amount because the economic benefits, what you're expecting from that usage of that asset is consistent, like in cases of buildings. So a building will give an organization the same amount of economic benefits every year, and hence we charge an equal amount of depreciation for an equal amount of depreciation every year for that usage of that asset. So how do you calculate it? Is simple. You take the cost and you minus the estimated scrap value. Together we consider it to be as your depreciable amount divided by the estimated years for which the business will use the asset. Remember this thing that the asset might have a much higher life, but the depreciation will be charged based on the number of years for which the organization is actually going to use it. On the other hand, the second method of a depreciation, what you have is reducing balance. Now, in this type of method of depreciation, we charge higher depreciation in the initial years as compared to the later years because the benefit or the usage of the asset in the initial year is much higher as compared to the later years, like in case of motor vehicles or equipment. Here you will be given a rate of a percentage multiply by the carrying value of the asset. With the help of questions, I'm just going to explain you how exactly we are going to apply these formulas and everything. Now, there could be a case where asset is bought and sold during the period, during the accounting period. So it's not necessary that you buy the asset from the very start of the accounting period. You might do it in the mid of the year. In that case, you have an option. You have two options. Either you can charge a full year depreciation, although you had, let's say, for 6 months that asset in the first year. Uh, and but what you will do is that in the year of disposal, when you are selling the asset, you will not be charging any depreciation, or you can simply reflect the depreciation based on the month. So for example, if in the first year you had the asset for 6 months, so instead of charging an annual depreciation, I might charge it only for 6 months. So it's up to the management policy that what's their policy of charging the depreciation. They have two policies. Either they can do monthly pro rata, or they can charge a full year depreciation in the year of acquisition, and then once they are selling off that asset, they might not charge any depreciation in that year. Now, here we do have a question regarding reducing balance method first. It says that where is a trader purchased an item of plant for $1,000 on 1st August 2011, which depreciates on the reducing balance at 20% per annum. So in this case, the depreciation method, what he has decided for this plant is reducing balance, and the rate is already given to you in the question, which is at 20% per annum. Now, the question is, what is the depreciation charge for each of the first 5 years if the accounting year end is 31st July? So you see, in this case, the asset was bought on 1st August, which is the start of the accounting year. And so we don't have to worry about the months in this case, but this question will simply explain you that how to charge reducing balance method depreciation. So what I'm going to do is, for the first year, I need to take the cost of the asset, which is 1,000, and I'm going to charge 20% depreciation on that. So this will give me 200 for the first year. Okay. So 200 is the depreciation charge for the first year. So in the balance sheet, you can see that the cost of the asset was 1,000 when we initially purchased, but then we have charged 200 depreciation. So now the value of the plant in the balance sheet of this trader will be 800. And this is what we call it as your carrying value, or we even call it as your net book value. And that's at the end of the first year. So for second year, now what you're going to do is that you won't be charging the depreciation on the cost. Only in the first year we charge the depreciation on the cost, but from the second year onwards, you have to charge the rate of the depreciation uh, on the carrying value. So now in second year, the carrying value is 800, and we have to charge 20% on that. So that will give you 160 depreciation for the second year. Okay. So far, the cost of the asset was 1,000, and you do understand that we have charged a total depreciation, or we call it as your accumulated depreciation of 200 and 160. So we have a total accumulated depreciation of 360, and hence the carrying value of the asset by the end of the second year is 640 now. So that is the carrying value, or we can even call it as net book value at the end of the second year. Now, for the third year, again, we're going to repeat the same process. Now the carrying value of this asset is 640. We're going to again charge 20%. So 640 into 20% will give you a depreciation charge of 128 for the third year. Yeah, I'll just shift it over here. Right. So now we have a total accumulated depreciation of 360 was in the first 2 years, plus 128 for the third year, and now we have a total of 488. So now the carrying value of this plant is 512. Or we can even call it as your net book value at the end of the third year. Likewise, we can also do it for the fourth year. So now the carrying value is 512. Again, you will multiply with 20%. So this will give you a depreciation charge of 102.4. I'll just round it down. So it's 102 depreciation charge for the fourth year. So now the net book value of this asset will be 488 till the third year end and 102 for the current. So total it's 488 and 102. The total will be 590. And now the carrying value of this asset is going to be 410, or the net book value at the end of the fourth year. The question asked us to do it for 5 years. So this is going to be the last year, which is going to be your fifth year. And now as the carrying value is 410 multiplied by 20%. So now the depreciation charge would be 82 in this case. Yep, 82. And that will be the depreciation charge for the fifth year. So now by the end of the fifth year, the cost of the asset was 1,000. We have collectively charged a depreciation of 672, and the carrying value of this asset will be 328 at the end of the carrying value, or the net book value at the end of the fifth year. So as you can see in this question, the amount of depreciation was higher in the initial years. It was 200 in the first year, then 160 in the second year. And you can see the amount of depreciation what you have is getting low as the years are passing by. So you can see that it is charging a higher depreciation in the initial years as compared to the later years where the depreciation amounts goes to low. Now, in this question, if you see that Kai has been running a successful nursery school, Little Im, since 2011, Kai bought the following asset as the nursery expanded. So there have been two assets which have been bought by Kai. It says the first one is a new oven for the nursery kitchen at a cost of 2,000, which was purchased on 1st December 2014, and a minibus to take the children on trips for 18,000 that was purchased on 1st of June 2014. Now, Kai depreciates the oven at 10% straight line. So for the oven, it has a straight line way of depreciating. And for the minibus, it's doing it on the reducing balance at the rate of 25%. And the company's policy is that to charge a full year depreciation, no matter how many months in that year you have owned that asset, you will be charging a full year depreciation. But in the year of disposal, you won't be charging any depreciation. The requirement of the question is that you need to calculate the total depreciation charge for the year ended 31st October 2016. So I'm going to do one by one. First, we will talk about oven. Now, you see that this was bought on 1st of December 2014, correct? So this company's year is ending up at it's ending up at 31st of October 2015, right? So this is the first year, but the question is actually asking about the second year. So in this year, I'll write it down over here that this is the accounting period end. Okay, so this period would have started from 1st November 2014, right? So that's the accounting period start you have. And this 1st December 2014 is the date of acquiring the oven, the asset. So you see that it's not for one full year. It was owned for only 11 months in the first year. till 31st October 2015. So as the cost of the asset is 2,000, I'm going to charge a depreciation of 10% straight line. Now, when it says straight line, it means that you have to charge, okay? So in this case, 2,000 multiplied by 10%, you will get 200 depreciation for 1 year, or we can say per annum. So for the next year also, which is your year ended 31st October 2016, the depreciation what you have to charge on the oven will also be 200. Now for the minibus, you see that the date of acquisition for this asset is basically on 1st of June 2014. Okay. And the year end is on 31st of October 2000 and 31st October. So the first year end what for this asset will be 31st August 2014. Now, although I just own the asset over here for only June, July, August, September, and October, only for 5 months, I will still be charging a full year depreciation because that's what the policy of the company is, that they need to charge a full year depreciation in the year of purchase and none in the year of disposal. So this is the first year. The cost of the asset was 18,000 and you will charge 25 percentage, which will turn out to be 4,500 depreciation for the first year, which is 31st October 2014. Then for the next year, which is 31st October 2015, it will be 18,000 minus 4,500. So I'm going to get the net book value, which is 13,500 by 31st October 2014. So this was the net book value of the asset by 31st October 2014. Now for 31st October 2015, I'm going to charge depreciation on the carrying value, which is 13,500 multiplied by 25 percentage. And in this case, you will get around 3,375 depreciation for the second year. And that's by 31st of October 2015. But that's not what the question is asking from us. We need to find it out for the third year. So in that case, what I'm going to do is that the cost of the asset was 18,000. And as you know that 4,500 has been charged depreciation in the first year and 3,375 has been charged in the second year. So total depreciation of accumulated depreciation is 7,875, and hence the carrying value of this asset by the end of the second year will be 10,125 net book value by 31st of October 2015. So now because I have to find out the depreciation charge for the year 31st October 2016, I'm going to get the carrying value, which is 10125, 10,125, and then I'm going to multiply it by 25 percentage. So 10,125 into 25 percentage, you get 2,531. Okay, that is the depreciation for the third year, which exactly the question is asking from you, and that's going to be 31st October 2016. So by the end of the year, the net book value of this asset will be 7,875 was the depreciation being charged in the first 2 years. And in the next year, third year, I charged 2,531. So the total depreciation that has been charged in these 3 years has been 10,406. And hence the net book value of this asset by the end of the third year will be 7,594 by 31st October 2016. Now, what the question asked you was to calculate the depreciation charge for the year ended 31st October 2016. So for both the asset, the first asset we charge a depreciation of 200 every year. It was a straight line method, but for this one we charge 2531, and hence if you add them up you get to a total of 2731, and D would be your correct answer for this question. Now, in this question, it says that the following information relates to Bangers and Smash, a car repair business. They have two machines, machine one, machine two. The cost of the both machines have been given to you, which is at 12,000 for machine one and 8,000 for machine two. The purchase date for the first machine is 1st August 2015, whereas the purchase date for the second machine is on 1st October 2016. Now, the depreciation method for the first machine is straight line pro rata. When it says pro rata, it actually means that you have to prorate it for the months. And for this machine, second machine, it's 10% reducing balance pro rata. And your year end is at 31st December. Now, for the first machine, it's August 2015, and you kept it for August, September, October, November, December, 5 months only. So, and this asset was purchased in the next year. So, this asset has nothing to do with the depreciation for the 2015 for the first year. Okay. So, right, multiply by 20 percentage. So because if it's charging 20 percentage depreciation in 1 year, it indicates that the life of this asset is only for 5 years. 20 percentage depreciation, so that will give me around 2400, but that would have been the depreciation if I would have kept it for one whole year. But in this case, as I told you, that it's only for 5 months, which is from August to December. August, September, October, November, and December. It will be have to be prorated by 5 by 12. So 2400 multiplied by 5 divided by 12, you get 1000 depreciation for this asset. So by the end of the first year, the net book value of this asset will be 11,000. And likewise, from the next year onwards, you can charge a full year depreciation of 2000. So this will be the depreciation you need to charge in 2015 for this first machine. And for the next year, which is your 2016, there will be a total depreciation of 2400 that's charged every year. So that will be the depreciation for 2016 as far as your machine one is concerned. So far, either the answer can be B or D, because 2400 is not the depreciation. It's only going to be 1000 because the company has a policy of prorating. Hence, 2400 is not the correct answer for 15. It will be 1000. So either B could be the correct option or D could be the correct option. Likewise, for machine 2, we don't have to charge any depreciation on this asset in the first year 15, because we actually purchased it on October. So it has been from October of 1st October 2016 to 31st December 2016. So it was only there for 3 months. Okay. So 8,000 is the cost of that machine. Multiply by 10 percentage reducing balance. So that gives me a total of 800, but I'm not going to be charging it for one full year. I will be only charging it for 3 by 12. So that gives me to around 800 multiplied by 3 divided by 12, you get 200, I believe. So 200 would be the depreciation for on this asset machine 2 for 2016. So the total depreciation what we'll be charging in 2016 on both of these machines would be 2400 over here and 200 over here. So that makes up to a total of 2600. And yeah, so in that case, B would be your correct answer and not D. That means that you're charging here a depreciation of 800, but you need to prorate it. Hence, the depreciation would only be 2600. So B is the correct answer. Because for the first machine, you have 2400 depreciation. And for the second, if you add 800 by mistake, you will get 3200, which is the wrong answer. You only have to add 200 because it has to be prorated for 3 months. And hence the total depreciation for that specific year would be 2600. Now, as we have understood as to how to calculate the depreciation, we need to understand that what will be the double entry for depreciation. So that double entry for depreciation expense is debit depreciation expense, and that's going to be charged in your income statement. And you're going to credit an account called as the accumulated depreciation, and that's to be recorded in the balance sheet. Now, uh, as you keep on using the asset, you have to reduce the cost of the asset, which is done with the name of accumulated depreciation. And that's why, because we are reducing the cost of the asset, it's on the credit side. And where is it going? It's been shown as an expense, which I earlier explained to you that that's the expense what we are recording, not as a cash expense, but as a provision over here for the use of the asset, which is reflected in the expense of depreciation. So the accounting entry for the depreciation would be to debit the depreciation expense in the income statement and to credit the entire accumulated depreciation and reduce it from the cost of the asset, so that when you prepare the balance sheet, you show the net book value or the carrying value of the asset. Now, in this question, it says that Sam runs a large toy shop in Windsor during the year ended 31st August 2015. So that's your year end over here. Sam purchased the following non-current assets. So these assets have been purchased during the current year. A new cash register for 5,000. This was purchased on 1st December 2014 in time for a Christmas rush and was to be depreciated at 10% straight line. So you have a new cash register which you purchased for 5,000 on 1st December 2014. So this means that this asset has not been there for one whole year with you. It was only for 9 months with you. And it was purchased at a cost of 5,000, and the depreciation policy what has been chosen for this asset is straight line. For the on the other hand, you have a new delivery van also purchased on 31st March 2015. So that's only like April, May, June, July, August. So 5 months. Yeah. April, May, June, July, August. Yeah, 5 months. 5 months before the year end. And that has been purchased at a cost of 22,000, and but this will be depreciated at 15% reducing balance method. And it's also given over here that the SAM charges depreciation on a monthly basis. So means that you have to prorate the depreciation. So in this case, for the new cash register, the cost of this is 5,000, and you need to charge a depreciation a straight line of 10%. So every year that will be 500. Okay. And this has been from December to August. So it's only for 9 months. So the depreciation for the current year will only be at 375 and not for 500 in total. It represents 9 months depreciation. For the new delivery van, it's 22,000 multiplied by 15 percentage. And but this will be only charged from the month of April to August. So April, May, June, July, August, that's 5 months. So 22,000 multiplied by 15 percentage. Normally for one year, you would have got a depreciation of 3,300, but we need to prorate it by 5 by 12. So 3,300 multiplied by 5 by 12, I get a depreciation of 1,375. So the total depreciation charge would be 1,375 and 375. So that will give me a total of 1,750. So the total depreciation charge for the year will be 1750, and that answers the first part of the question, which was what is the depreciation charge for the year ended 31st August 2015. So that's 1750. 375 has been charged on the new cash register, and 1375 has been charged on the new delivery van. If the new cash register would have been there for the entire year, that's like if you would have purchased it on 1st of September 2014, then 500 would have been charged. And likewise for the new delivery van, if that would have also been purchased on 1st of September 2014, then you would have charged 3300 depreciation for the entire year. But in this case, because they have been purchased for 9 months in case of new cash register and for 5 months for new delivery van, the depreciation charge has been prorated, and hence the total depreciation charge now stands at 1750. Now, the next part of the question actually asks you to prepare the ledger accounts. So we'll be producing the ledger accounts over here. Now, if you see the first ledger account, what we have would be of the asset. Okay. So I'm going to try to make one account. Okay. So this is your T account over here for the asset. So these assets we can put them together. Let's say like we can call them as equipment together. If you want, you can make a separate account for your cash register and for your uh, motor van. So I'll just consider it to be as assets over here. And this asset is at the value of cost. So once you purchased the asset, now as you know that the right side of this T account is credit, and the left side is the debit in this case over here. So now once we have purchased the assets, we have to write it down on the debit side over here. So we'll write down over here. The first one what we had was your cash register. So that cash register, and the amount of that cash register was 5,000, I believe. And the next one, the asset what we had was your um, the motor van, I believe. So that motor van will be of 22,000. Yeah. So 22,000 over there. So these are the two assets which have been recorded on the debit side of the account. And okay, so in the second part of the question asks you to prepare the ledger accounts, the relevant ledger accounts uh, for the question. So in this case, we will prepare a ledger account. I'll just try to make one ledger account so that I can actually help you to understand the concept. But you can make, like, for every asset, you can make up a separate account. But in this case, we will just kind of make one account to help you understand that how the ledger accounts will work. So we'll try to make, okay. So this is my first account, which is the asset account. And okay, right. So I'll write down the title of this account, which is your asset. I'll just call it as asset, but you can make up a separate account for your delivery van, and you can also make up a separate account for your the cash register. But in this case, I'll just call it as asset, and this account is made at a value of cost. So now this side is your debit side, and this side is your credit side. Now here, what we have to do is that your assets have increased, so we will be using the debit side. And let's suppose that you paid cash or bank, uh, you paid cash for those assets. So the first asset which you purchased was worth 5,000, which was your cash register. And the second asset which you purchased was your delivery van, which was again assuming purchase on cash. So you can see that the asset is being debited in the account against cash. for the first asset and for the second asset. First asset was worth at 5,000 and the second asset is worth at 22,000. So the total purchases of asset what you have done is 27 in this case. Now that let's suppose it's the end of the first year. So in this case, we have to close this account. We will write down over here your balance carried down, and that will give me a total amount of 27,000. So this account actually lets you know that 27,000 of worth of assets you have, right? Now, next time when you open up the account, it will have an opening balance over here of 27,000. So I'll write down over here your opening balance, and that will be at 27,000. So then in case if you purchase more further asset, it will be recorded uh, um, after this 27,000. It will adjust to the amount of 27,000. Now, after this, the next account what we have to make is of your accumulated depreciation account. And this also I'm trying to make it for both the assets together, but you can make it for every asset individually. So in this case over here, you have accumulated depreciation account for your assets. Okay, and here just draw the line. Okay, so the accumulated depreciation is credit against depreciation. So we will be using our credit side over here. This is the depreciation expense you have charged on the cash register, and with the amount of 375 if you remember. And then we also have charged depreciation expense on your second asset, which was your motor van, and that was of delivery one, and that was of 1375. Hence the total depreciation what we have charged is 1750, I believe. Yeah. So here you will close the account. Here you will get your balance carried down because this is the lesser side. So you will put your balance carried down of 1750. So when you're preparing your balance sheet, you see your assets are have an balance over here of 27, and the depreciation what has been charged is 1750. I'll just try to complete this account by showing you the opening balance also. Here and here we're going to write down the opening balance of this account would be 1750. So when you're preparing your balance sheet, your assets will have a cost over here of 27,000, the total. And then from that, you will subtract your accumulated depreciation, which is 1750, and you will get the net book value of your assets or the carrying value, which is 27,000 minus 1750. I get 25250, and that's the value on which the asset will be shown in your balance sheet, 25250. If you wanted, you can do it separately for both the assets. Like you can make one cost account and one accumulated depreciation account for your van, for the delivery van, and likewise a separate one for your new cash register also. I would also like you to show the depreciation account over here. So for depreciation account, what you have to do is that this is my depreciation account. Now this depreciation account over here, okay, so the depreciation expense was being debited. So what I'm going to do is I'm going to say depreciation account debit. So this is the debit side over here. And against the accumulated depreciation, what you have for your The first one was cash register, which was at a valuation of 375, I believe. And the second one was your uh, the accumulated depreciation for the motor van, or sorry, the delivery van, which was at 1750. Sorry, 1375. Yeah. So now all of this depreciation, you don't have to, because it's an expense account, so you don't have to do a brought down and a carried down for them. These accounts will be transferred into something called as your income statement. So when we are preparing the income statement, this account has to be closed and the balance of 1750 will be transferred into your income statement. So this is how you're going to supposed to make your depreciation account. Now, moving further, when we were calculating the depreciation, we had a lot of estimates. That was your estimated scrap value or the estimated useful life for which the assets are going to be used by the organization. But these estimates can change. Okay. So now should be reviewed at the end of each reporting period. So every year end, the organization has to review these estimates and have to change them if expectations are significantly different from the previous estimate. So if I was estimating that the life of the asset will be 5 years, but then I realized that no, it's not five and it's 10, for example, in that case, I have to revise the estimates. Now, in that case, it's called as a change in an accounting estimate. These are all estimates which you do in preparing the financial statements. And if there has been a change in accounting estimate, you have to treat it respectively. Like it will not affect your previous years, but from now onwards, you have to account for the change in the estimates. Okay. And that's how we're going to change the estimates, the carrying amount of the asset at the date of revision. So you will find out that what has been the carrying amount of the asset when you are changing the estimates, less any of the revised residual value, which you believe you might still get from disposal of the asset, and you have to depreciate it over the remaining useful life. Now, with the help of question, we would be able to understand this thing more clearly. Now, in this question, if you see that Elfie purchased a non-current asset for 100,000 on 1st January 2012 and started depreciating it over 5 years, residual value was taken as 10,000. So 100,000 minus 10,000, that's your estimated scrap value. So this gives me a depreciable amount of 90,000, and this 90,000 was to be supposed to be depreciated over a period of 5 years. So hence every year the depreciation what I would have been getting would have been 18,000. Okay. So at 1st January 2013, that's like just like one after 1 year. So 100,000 is the cost of the asset. The depreciation would have charged in the first year is 18. So this gives me a net book value of 82,000. Now at 1st January 2013, a review of the asset lives was undertaken, and the remaining useful life of the asset was estimated at 8 years. From your original estimate, it should have been 4 years, but now you believe that it will be useful for you for another 8 years, and the residual value was estimated to be nil. So this assumption has also been changed. Initially, you were expecting that you will be getting 10,000 at the end of the fifth year, but now you're going to be using it for a further 8 years, so total 9 years basically, and you will not be getting any residual value at the end of it. So now the revised carrying value, what we have is 82,000 minus we don't have any scrap value. So now this 82,000 is the new depreciable amount which you have to which you have to depreciate over a period of 8 years. Okay, the remaining life. So 82,000 divide by 8, you will get a depreciation of 10 to 50. So that answers the question that calculate the depreciation charge for the year ended December 2013. That's like after the change in the estimates and subsequent years. So for the next 8 years, we'll be charging a depreciation of 10 to 50 every year. Now, here we also have another question on the change in the estimates, which says that you bought a wood burning oven for 30,000 on, Yan bought a wood burning oven for 30,000 on 1st of January 2010 to use in a new restaurant. At that time, he believed that the oven's useful life would be 20 years, after which it would have no value. So, zero scrap value. So, this has to be 30,000 being depreciated over a period of 20 years. So this will give me a depreciation of 1500 every year. Now, after on 1st January 2013, so that's like 2010, 11, 12, like after 3 years. So after 3 years, if you see, uh, the accumulated depreciation on this will be 4500, and the carrying value will be 25,500. Okay, so this is the case after 3 years. On 1st January 2013, when the carrying value of this asset is 25,500, Yan revised the estimations previously made. He estimated that the life of the oven to the business was reassessed to a further 12 years, after which it could be sold for 1,500. So now at this level, I'm saying that I expect to get 1,500 by the end of the 12th year. So I'm going to be saying revised uh, uh, carrying value at the time of the revision, which is 25,500, minus the estimated scrap value, which I believe to be 1,500. And this will give me my new depreciable amount, which is going to be 24,000. And I will be depreciating it over a period of remaining useful life of 12 years, for which Yan expects that he will be using this oven. So in that case, it will turn out to be 24,000 divided by 12. You get 2,000. So the depreciation charge for the year ended December 2013 will be 2,000. So A is considered to be as your correct answer for this case. And the net book value of this asset was 30,000. The cost was 30,000. You've been charging 4,500 depreciation in the first 3 years, and then you charge 2,000 for the fourth year. So total depreciation charge would be 6,500, and the net book value of this asset will be 23,500 at the end of December 2013. That's like after 4 years of acquisition. Net book value at 31st of December 2013. Now, the last thing what we have for this session is your non-current asset register. Now, this is actually a register maintained by the organization so that they can keep a record of all of their non-current assets. Now, it's actually part of an internal control system of an entity. It's a control over their non-current assets so that they have a register in which all the details about the assets are maintained, and hence no asset can go missing. If it's there in the register, it should be physically present also, and vice versa. What they will write down on the register is basically that what was the cost of the asset, when did we purchase, a brief description about the asset. They might do a coding for that asset, a reference number, in which department or where is the location of that asset, what depreciation method are we deciding to use for that specific asset, its expected useful life, and the net book value of the asset at the end of each year. So all of these details, you will be finding it out in a non-current asset register of a company, in which the details of the non-current asset held by the entity are maintained. Thank you very much.